Traders, welcome to the Independent Quant, where I help traders turn their trading ideas into algorithmic strategies without worrying about all the code and theory that may go along with it. I'm the founder of the Independent Quant, Luis. This is one of our first videos, and today we're going to talk about what is quantitative trading. 75% of all trades done in the market are done algorithmically or by way of a computer with no human intervention. That in and of itself may or may not be quantitative trading. Quantitative trading, in its nutshell, is three things. It's a way to make data-driven decisions using backtesting and validation and risk management. That's the core of the fundamentals of quantitative trading. Now, data-driven decisions, what does that mean? What quantitative traders do is they build models using historical market data along with other data sources that they deem important and fit whatever trading goal that they need to achieve. They find signals using all that data, and with that they make decisions as to which trades to put on, but it's all based on data. It's a data-driven approach, systematic approach to trading. Now, one thing I should mention is for the Independent Quant, I use a couple of different terms. I use quantitative trading, I use systematic trading, I use algorithmic trading, and I use discretionary trading. If we go out into industry, quantitative trading is trading using historical data and statistical models in order to make trading decisions. Fair enough. Here at the Independent Quant, I broaden that a lot more, and I include systematic trading as part of that. So systematic trading is simply trading a system that is rules-based. Now, that rules-based may or may not have data associated with it, but there may have been tests associated with it. Algorithmic trading is simply trading with an algorithm. But if you do any of those three things, quantitative trading, systematic trading, or algorithmic trading, you're in the right place. The Independent Quant is for all three aspects of that. But again, since we're talking about quantitative trading here, the differentiator is that data-driven aspect of it and the use of really any data source that you can get your hands on. Now in 2025, what computers can process is significantly more powerful than any other time in history. So that's number one. The next thing that distinguishes quantitative trading for other styles of trading is backtesting and validation. What does that mean? So you have a trading idea, you build a model to reflect that. You can backtest, meaning you can take a period of time that you feel reflects the market that this strategy is going to operate in, and you actually test to see how profitable that strategy would have been in that period of time. Now, the big point there is that that period of time should reflect the market conditions that this quantitative strategy is going to be running. Then the next step after that is validation. You can validate a strategy, which means you can take that strategy and run it in a paper account and simulate trades with it to ensure that, yes, it is profitable in the current market before actually putting real money to it. So that's a huge benefit to quantitative trading. What that allows us to do is we can have a constant stream of ideas, and we can convert those ideas in a way that a computer can understand it and backtest them. So we can iterate so much faster than we could in systematic trading or really any other method out there. Next is not unique to quantitative trading, which is risk management, but how you can implement it is unique to quantitative and algorithmic trading, which is the computer now is following a set of rules to control your risk management plan. Otherwise, you would have to do this on the fly, or you would have to do this individually to position size each one of your trades and make sure that they're in compliance with the risk management plan. You can just systematically include that in your quantitative trading model, and it would be taken care of. Now, the last element of quantitative trading that is not required is automation. But that's why I only mentioned that there's three big pillars for quantitative trading, and didn't mention this last one, but automation. This is usually the whole point of algorithmic trading, which is now you are taking that strategy and you're letting the computer actually execute it for you. It's not really a requirement because there are quantitative traders that simply want to have the computer find the opportunities for them, maybe even grade them, rank them, but ultimately a human being is going to make the decision as to which trades are going to be placed. And for the independent quant, I'm making the assumption that you are automating your strategies. If you're not, that's okay. But if I assume that you are going the full distance of automating your strategies, that means that I can speak to a much larger group, right? It doesn't exclude anyone in any significant way. If you only want to learn how to find signals and build a strategy to do that, you're still in the right place because that is part of the entire process. You're just not doing that one final step, which, like I said, is not required. Now, to distinguish quantitative trading from discretionary trading, the general definition of discretionary trading is the wild, wild west. It means that you are looking at a chart and making decisions based off of your biases, any information that you're getting, be that news that's coming out, reports that are coming out, an analyst on the news channels. That's discretionary trading. There is no system to it. You are using discretion and your opinions, your intuition, in order to put on your trades. The challenge with that, you can become successful with it. However, you have to be very disciplined and you have to understand what conditions it is that you are actually putting these trades in. Because if you're purely allowing your emotions to dictate when you put on a trade or not, it's very difficult to understand what's working, what's not, and you can't expedite your road to success, which is being a consistent, profitable trader. Quantitative trading helps us because it removes us a lot from that entire process. It's using a method that has been validated and tested. So that's the big difference between quantitative trading and discretionary trading. If what I've said has, tickled your fancy and you want to learn a whole lot more, sign up for our newsletter. And I do have a mini course that introduces trading with the specialization into quantitative trading. Feel free to take that course. It's free, and it's a great first start for your journey into this world of quantitative trading. Thank you so much for tuning in. Until next time, traders, keep it green.